Do you know the difference between cash basis and accrual basis when it refers to accounting methods or financial statements? Which one is better to use and which one should you use?
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with certified public accountant Tina Moe.
You've probably heard the terms cash and accrual before, but what do they really mean? Let's start with the cash basis method of accounting. This method, simply put, means that you record income when it is actually received, not when it's earned. And you record expenses when they are paid, not when they are incurred. Here in the U.S., most individuals are considered cash basis taxpayers, but there are 4 types of taxpayers that are not eligible to use the cash basis if their gross receipts are too high or they don't meet other exceptions. These are C corporations, partnerships with at least one C corporation partner, tax shelters, and taxpayers required to keep inventory, such as retail, wholesale, or manufacturers. The reason behind this last exception has to do with the upfront cost of acquiring or manufacturing inventory for resale, that you cannot expense these costs until the inventory is sold. Therefore, inventory prior to its sale is an asset, not an expense. Most of my small business clients are on a cash basis, and this is good tax strategy in my opinion. Why pay income tax on revenue earned but not yet paid by your client or customer? And at year end, escalating expenses into the current year is a great way to shift expenses from next year to this year to reduce this year's profits. This isn't always the answer, but certainly worth looking at if you've had a very profitable year. Now let's look at the accrual basis of accounting and taxation. This method records income when it's earned, not when it's paid by your customer or client. So if you generate an invoice to your client, this amount will appear on your profit and loss in the month it was invoiced, not when it was paid by your client. And the accrual method records expenses when they are incurred, not when you actually pay them. So if you receive a bill from your printing company in January, but actually pay the bill in February, this expense should appear on your January profit and loss. Sound pretty easy? It really is, but as in virtually all accounting and tax laws, there are exceptions, ifs, ands, and buts. So if you're not sure about a certain transaction, make sure you ask your accountant for guidance. And here's one more little tip. When I'm working with a business client and analyzing their financial statements, I look at the accrual-based statement when analyzing one accounting period over another, because this is the best indicator of business performance. But when I'm analyzing the financial statements for tax planning purposes for a cash basis taxpayer, I use the cash basis financial statement because this most closely matches what the taxes will be based on. And by the way, if you're a QuickBooks user, you can easily toggle between the two methods of reporting in the Customize Report feature. For more information, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.